Welcome to the week that was, where we distill the just overwhelming flow of market data and regulatory action into the insights you really need.
Okay, let's unpack this. The last few days, they've been a study in paradox for the digital asset space.
A total paradox.
On one hand, you look at the charts, they look shaky, prices are whipsawing everywhere, and there's, some genuine fear out there.
Yeah, all reacting to global interest rate uncertainty.
But then, at the very same time, the foundational plumbing of the entire global financial system is being, well, permanently rewritten in favor of crypto.
And it's absolutely critical for you to filter this environment correctly. You really have to distinguish the short-term noise, the minute-by-minute price drops, from the long-term signal.
And that signal is the structural breakthroughs.
Exactly. The breakthroughs happening at the federal level, regulatory bodies, they're no longer trying to just contain this industry. They are actively integrating it deep into the banking system. So our mission today is to cut right through that noise. We're going to examine the fallout from the Fed decision, look at the, frankly, historic U.S. regulatory pivot that is truly onshoring the crypto economy, and pinpoint the security threats and institutional strategies that are going to define this next cycle. Let's start with the drama then. Before the FOMC meeting, the market was just wound up.
It's like a coiled spring. That's the perfect description.
For days, Bitcoin was just trading in this high-tension, animated stasis. Everyone knew a big move was coming. It was just bouncing tightly between, about $92,000 as a floor?
A critical demand floor, and about $94,000 as stubborn resistance.
And the Fed was the detonator.
It absolutely was. They delivered the widely expected 25 basis point rate cut. Now, typically a rate cut is good for risk assets.
Right. That should have sent things flying.
But the reaction was decisively bearish. This happened because the market immediately saw it as a hawkish cut.
A hawkish cut. That sounds like an oxymoron.
Yeah.
Break that down for us. How does lowering rates end up spooking the market?
It all comes down to policy uncertainty, or what we're calling policy fog.
Policy fog.
Yeah. So first, the decision wasn't unanimous. It was a 9-3 split vote. And that's highly visible. That kind of deep internal conflict, it signals to the market that officials aren't on the same page about inflation.
So turbulence ahead.
Turbulence ahead. And second, Chairman Powell's forward guidance for 2026 was extremely cautious. He basically implied that even though they cut rates now, the easing cycle might be shorter or, slower than traders were hoping.
So the market sold the news because the Fed didn't promise enough free money down the road. What did that look like on the chart?
It confirmed a classic bearish structure. The pivotal moment was the failure to reclaim a key resistance level, specifically the Fibonacci level at $94,253.
And when it couldn't hold that?
The bounce was confirmed as just corrective, not the start of a new rally. We saw a really quick retreat that confirmed a major reversal pattern that analysts have been watching for a while.
So if you're a short-term trader right now, what are the key risk areas you're watching?
The immediate fight is right around that psychological $90,000 floor. If that breaks decisively, the technical downside target is somewhere in the $83,000 to $85,000 confluence zone.
And that zone is important because
that's where a lot of institutional bid orders are concentrated, and there's more. If the market fails to hold 88,750, some technical analysts are tracking a pattern that could target as low as 76,000.
Wow. And to invalidate all this bearishness?
We need to see a sustained price above 94,700. That's the bullish reclaim level.
Okay, that's the short-term picture. But here's where it gets really interesting. This is the huge irony, and why you can't just look at rates.
Yes.
Despite the Fed talking tough on rates, they are acting, completely differently on liquidity.
This is the hidden tailwind. Analysts are calling it stealth QE. While everyone was obsessed with the interest rate, the Fed quietly announced it's going to purchase $40 billion a month in short-term treasury bills.
$40 billion a month. And this is essentially just expanding their balance sheet.
It is. It's pure liquidity injection. And this is the key point. Historically, Bitcoin correlates way tighter with central bank balance sheet expansion than it does with the interest rate itself.
So talk is cheap, but liquidity is real.
You got it. When the Fed buys T-bills, they're injecting reserves directly into the banking system. So while they sound hawkish, they're simultaneously opening a huge liquidity tap. That $40 billion a month is fuel that has traditionally flowed straight into hard assets.
So if you're watching the price drop, you have to remember that the Fed is literally creating the very liquidity environment that has historically helped assets like Bitcoin grow. That's A profound contradiction.
It's the contradiction defining this market.
All right, let's pivot now to the structural signal that I think completely dwarfs all this price noise. We are moving past the era of regulation by containment in the U.S.
We really are. The pivot is now regulation by integration, and this is truly the story of the week. The Office of the Comptroller of the Currency, the OCC, granted conditional approval for national trust bank charters to 5 industry titans.
And the list is just a who's who. Circle, Ripple, BitGo, Paxos, and Fidelity Digital Assets.
This isn't a pilot program. This is a permanent integration strategy.
So explain the revolutionary impact here. What does a federal national charter actually do?
Oh, the implications are enormous. The first one is federal preemption. Before this, if you wanted to operate across the country, you had to get like 50 separate, expensive, often contradictory state money transmitter licenses.
The huge regulatory headache.
A massive drag on the whole ecosystem. A national charter lets these firms operate uniformly across all 50 states. It just instantly removes that friction.
Okay, so that simplifies compliance, cuts costs, great for business. But there's a second, even more critical piece tied to the Fed itself, right?
Absolutely. This is the structural breakthrough. These new national trust banks are now eligible to apply for master accounts at the Federal Reserve.
And why is getting a master account so profound?
Because for years, the industry's greatest vulnerability has been what's called debanking.
Right, where a commercial bank just decides to cut you off.
And you're done. Crypto firms had to rely on banks like Silvergate or Signature to access the dollar system. A Fed master account changes everything. It allows direct, instantaneous settlement via FedWire. You completely bypass the commercial banks.
So the government is basically building a permanent on-ramp and off-ramp for the crypto economy that private banks can't just shut down.
That's it exactly. And that fundamentally validates the stablecoin model, especially for Circle with USDC and Ripple with their new RLUSD. Their reserves can now be housed as federally regulated trust assets. For a big institutional treasurer, that just dramatically elevates the safety profile.
But doesn't this put enormous compliance pressure on these firms? I mean, isn't that an added cost that could slow innovation down?
It definitely introduces more rigor, no question. They have to operate under the same high standards as any national bank. But for the big clients, for institutions, that burden is a feature, not a bug. They want that compliance.
They want the guardrails.
They need the guardrails. It's how you transform this space from a tech play into a regulated financial utility. It's the trade-off you have to make to attract trillions in institutional capital.
And it wasn't just the OCC. The CFTC was also quietly making moves this week.
Yes, the CFTC withdrew some restrictive 2020 guidance on actual delivery. It's a bit technical, but this change basically enables the launch of the first federally regulated, physically settled Bitcoin futures market through an exchange called Bitnomial.
Which is huge for institutions wanting onshore leverage.
Huge, and we're seeing traditional finance jump in before the ink is even dry. PNC Bank, a top 10 U.S. bank, just launched direct spot Bitcoin trading for its private banking clients.
That's the trust arbitrage you mentioned. They're just wrapping Bitcoin in the safety of a familiar old-school bank brain.
Exactly. They are de-risking the asset for high net worth clients who were never going to use a standalone crypto exchange. It just shows that banks now see this as a permanent client service requirement.
Okay, so let's look at how the biggest players are positioning themselves for this new reality. We had to start with Strategy Inc., formerly MicroStrategy.
They're still the standard bearer. They just increased their holdings to, what is it now, 660,624 BTC.
An incredible number.
But the real strategic insight this week wasn't the buying, it was the defensive financing. They established a massive $1.44 billion cash reserve.
So why is having that much cash on hand so critical for a company that just buys and holds Bitcoin? How does that change the risk profile?
It explicitly removes the forced seller risk. That fiat buffer is designed to cover about 2 years of their interest payments on debt. This means if Bitcoin's price were to plunge in a bear market, they would not be forced to liquidate their Bitcoin to service that debt.
Ah, so they can just ride it out. That's a huge de-risking step.
Huge. And it's a model others will copy. It's a stark contrast to newer entrants like 21 Capital, which, had a really rough debut on the NYSE despite some big name backing.
So the market's saying, show me, don't tell me.
Exactly. The bar has been raised. Investors are skeptical of unproven models when they have fully compliant ETFs and established players like Strategy Inc. to choose from.
We're also seeing this fascinating convergence between digital infrastructure and the AI boom, especially in the mining sector.
This is one of the most significant investment themes emerging. The finance giant Citadel Securities, for instance, just disclosed a 5.5% stake in the miner Core Scientific.
And this isn't just a bet on Bitcoin's price going up.
Not at all. It's an arbitrage play on energy assets.
Okay, break that arbitrage play down simply.
The Bitcoin miners have scarce, valuable resources, energized grid connections, and massive data centers. With mining profitability being squeezed, they're realizing those physical assets are actually more valuable if they sell computing power to AI firms.
So they pivot from low-margin crypto mining to high-margin, high-performance computing, or HPC.
Precisely. Citadel is betting that Core Scientific is basically transforming from a volatile commodity business into a stable digital infrastructure REIT. Their whole valuation gets re-rated.
And the structural story is getting stronger globally, too.
Yeah, we saw massive moves. Pakistan granted no objection certificates of Binance and HTX, opening up a huge, previously restricted corridor for capital. In Europe, France's BPCE group rolled out direct crypto trading and custody to its millions of retail clients.
And finally, a huge move on the infrastructure front. The industry is tackling its Achilles heel, those cross-chain bridge hacks.
Yeah, this was critical. Coinbase selected Chainlink CCIP as the exclusive standard for its wrapped assets, which covers around $7 billion in value. This is a commitment to replace those vulnerable proprietary bridges with a decentralized security layer. It's all about securing the rails for institutional money to flow safely.
And while the infrastructure improves, accountability and security remain absolutely paramount. Let's start with the accountability news.
Accountability was delivered, and it was delivered swiftly. Duke Wan, the co-founder of Terraform Labs, was sentenced to 15 years in prison.
A historic closure for that whole 2022 collapse.
It really is, and it sets a clear precedent that jurisdictional arbitrage, hopping between countries to dodge law enforcement, is just not a viable strategy anymore for financial fraud in this space.
That sets the regulatory tone. Now, what stands out to you in terms of immediate practical security threats that our listeners need to be aware of right now?
The threats are focusing on the weakest links, the hardware and software surrounding your funds. We saw 2 critical active risks this week.
Okay, what's the first one?
First is a major hardware vulnerability. Ledger's security team found a flaw in MediaTek Dimensity 7300 chips. These are really common in mid-range Android phones.
And what does the flaw allow?
It allows for something called a side channel attack to extract private keys from hot wallets like MetaMask running on these phones. And because the flaw is in the silicon itself, the only real defense is to move any significant funds off those devices and into cold storage immediately.
That's terrifying. Okay, and the second risk, the software layer.
The second one is focused on Web 2, Web 3 bridge risks. State-sponsored actors, like the Lazarus Group, are using a vulnerability called React2 Shell to launch ether hiding attacks.
Ether hiding?
They embed malicious code on the Ethereum blockchain, disguised as contract beta, and then target DeFi front ends. You visit a compromised site, the code executes, and it tricks you into signing a transaction that drains your wallet.
So the lesson is verify the URL every single time before you connect your wallet.
Every single time. And just quickly, reinforcing the basics. The UK fined LastPass £1.2 million for a breach that led directly to crypto thefts. It's a loud reminder that password managers are not safe for your seed phrases.
And on a more positive note,
A beautiful reminder of the network's core promise. A solo miner with a tiny little rig beat 1 in 82-year odds to mine a block.
and secured the whole reward.
The whole reward. About $285,000. It just shows the network is still probabilistic and fair. The little guy can still win.
So what does this all mean? The market is sending two completely opposite messages at once. Volatility is here.
But so is legitimacy. Long-term structural legitimacy.
So how do you frame this moment?
The most accurate way is to see this as a handover phase. Ownership is fundamentally transferring from, let's call them weak hands, distressed miners, leverage retail, to strong hands.
Tier 1 banks, sovereign wealth funds, institutions.
Right. And in the short term, the price is still beholden to these macro threats.
Like the looming risk of the yen carry trade unwinding, which you mentioned. Quickly, for our listeners, what is that?
It's a major global threat. For decades, traders have borrowed Japanese yen at near zero interest rates and invested that cash in higher-yielding assets globally. If the Bank of Japan starts raising its rates, all those traders have to suddenly sell asset stocks, real estate, maybe crypto, to pay back their yen loans.
which creates enormous downward pressure on everything.
On all risk assets, so that explains the macro dread. But fundamentally, the OCC charters are the definitive, concrete foundation being poured right now.
We'll leave you with the key levels to watch. It seems like 90,500 is the immediate line in the sand for support. You need to see a clean break and hold above 94,700 to invalidate the bears.
And as we look forward, the regulatory comfort is just so clear. The OCC has approved national trust banks, and BlackRock has already filed for a staked Ethereum trust. Regulators are getting comfortable with complex on-chain yield generation.
As long as it's compliant.
As long as it's compliant. So the final provocative thought for you to explore is this. With institutions so desperate for compliant yield, how long until that intense pressure forces the creation of a standardized, federally regulated Bitcoin yield product, something that leverages layer 2 solutions or staking mechanisms to finally close that utility gap between Bitcoin and high-yielding altcoins? That is the next great inevitable frontier for institutional capital.